and 18,485. The mid-cap index, I think, will also come up. There is some gain there, about 0.15% or so is what we have. Nifty heat map maybe gives us a quick sense of what's up and down, although it should be, with a 10-point change, don't expect fireworks. It is more up than down at this stage. And I think one of the names two names we highlighted with our research team, Bajaj Finserv with Vivek, and just before market open, on one end, and some of the stuff in the red as well. Surabhi.
No, it seems like people have already left for the weekend. There's absolutely no movement. It's 20 points lower now on the Nifty. By the way, beyond the Nifty, Cochin Shipyard is interesting. 5.5% up once again. So watch out for some of these defense shipyard companies. Bajaj Finserv on the large cap screen after the block trade. So 1.3% up on this one. Dr. Reddy's, the stock that we were just discussing with the pharma analyst, 1% higher. Coal India, IndusInd Bank, Eternal has had a fantastic week. Eternal's put on about 8% so far this week. That's just 4 days. Let's see what it does today. JSW Steel is seeing a very little buying, but this is something we're talking 2-3 rupees on the stock, so this really doesn't count. ITC, BEL, it's flat, it's not moving, it's completely, undecided. On the lower side, Tata Steel is falling 1.5%. There's Shriram Finance, ICICI Bank on the lower side. Let's actually check the Bank Nifty. Bank Nifty is down 0.2%, approaching the RBI policy with caution. SBI is lower. There's, Bajaj Finserv we discussed even. Bajaj Finance is lower. Shriram Finance lower. So generally speaking, Jio Finance is also down. Financials, pretty cautious this morning. Nigel.
Well, that's right. Let's focus on a few stocks, though, based on news that are moving in. Tejas Networks, the stock got bombed out post its numbers. Now they've got 123 crores as the first tranche of the PLI incentive from DOT for the past quarter. So that stock, after seeing a sharp correction, they won an order as well of around 2,000 crores in the last 1 month. That's popping up a little bit. Ashoka Bilcon, that's the other name that's up and about. They won 1,390 crore LOI for traffic systems in 5 circles of Maharashtra. Street likes it. That stock is up. We have Praj Industries. They're collaborating with a company in Paraguay for a project, a biorefinery project. So that stock, in fact, is up close to around 2% or thereabouts. The ones with large trades, actually, they are bounced big time. Your Bajaj Finserv, there were some shorts in the system. The stock is marginally up. It's up close to around 0.5% or thereabouts. But there were some shorts in the system, and there was some call writing as well that's taken place. So I'll be interested to see what happens to the stock from here on. ZF Commercial, that promoter was likely to sell 3% by the large trade. That's got done. Stock zooming away as we speak. So good move out there. BSE Limited on its way to be a 3,000 rupees stock. One of the big movers in the last 1 month or so. It had a bit of a dip, and that dip got bought into flying away. Harsha Engineers, that's the other stock that's up close to 6%. It's coming as one of the top traded volume gainers as well. So that stock, in fact, is calling for attention. Now up close to around 6%. Big move is what we're seeing on that particular name. So the headline index, waiting by for the RBI governor. Just added there actually Hindustan Zinc. That one's up close to 2%. On Monday, we had told you that, in fact, if zinc prices are going to be strong and if those technicals are in place, there's only one listed player that you can play it via. That's Hindustan Zinc. It's not a one for a faint-hearted, but that stock, in fact, is doing well. And Vedanta owns Hindustan Zinc, so maybe some kind of positive rub-off on that particular name as well. Prashant.
No, absolutely. Silver as well, right?
Yeah, silver. Silver.
Yeah, silver is the one which
highest
is,
level in the last 12 years.
Yeah, it's maybe more to go with gold doing so well. So we'll see. But as Nigel said, only one player to really play that particular theme in the listed space at least. What else? 1,700 stocks are higher. It's still early to look at the market breadth, but 1,600 stocks are up and 500 stocks are lower. Guess which is the number one volume-led gainer right now on the NSE? It's Cochin Shipyard, once again. It's not a ship, it's a rocket. 2,500 on Cochin Shipyard, 3 million shares traded, and it's just gone berserk. Of course, it's an all-time high. It's a new all-time high every day. And this week, by the way, stock's up 27% to be precise. So Cochin is going and going. Garden Reach is starting. I mean, some of these, typically price action, there is one leader and then the other two follow slowly and then quickly. So we'll see. I mean, Garden Reach is up 1.25%. It's got very large volumes, and Mazgaon Dock is up about 1.25% as well. So there's Cochin, Garden Reach, and Mazgaon, 3 names which are doing very well. Yeah, I mean, other stuff, there's not very much. Maybe just, let Let me just sort this. Tejas Network, I think we already mentioned. Premier Explosives is up 5.5%. And I think it's slowly but surely coming back to its previous highs, which was made in, June last year. The high was about 908. Stocks at about 650 right now, but it's done very well from the lows. From 350 to 650 in what, 10, 15 days? That's Premier Explosives. So volumes are still picking up, so I guess we'll give it some time. RK Forgings is up about 2% or so. There was, of course, that inventory mismatch issue, the promoter coming in and putting in money. So 618 is coming out with volumes, and that's why I'm mentioning it. So yeah, I mean, 3:1, almost 3:1 in favor of advances is what we have at this point. On the downside, I can spot CG Power, which is down about 2.25%. Bank of Baroda is down about 2%. I'm not sure if there's any news flow here, but these are some of the biggest volume-led losers at this stage. But nothing large, nothing 5-10% kind of down at this point. And there is a grand sum total of 1 point change on the Nifty. 24,750 is where we're at. Dheeraj Agarwal is with us, Managing Director at Ambit Investment Managers. Dheeraj, good to have you with us here. Thank you very much. Since the market is not doing very much here, I think it gives us the opportunity maybe to indulge in some, outside the market box conversation. So let's start. How do you? I mean, of course, I'm sure you've been following what's happened in the last 12 hours. This bromance between Trump and Musk coming to an abrupt, sharp halt. But from a policy, and I'm sure there are implications, right? I mean, because it's not a typical White House. They're trying to do a lot of things which have not been done for the last 30, 40, 50 years.
That's right.
So, in that sense, how do you assess? I mean, will this lead to a weaker administration? Does it, in a way, does it strengthen the hands of trading partners it's trying to put pressure on? And specifically for India, if you have any thoughts.
So the one clear thing which comes out of what is happening internationally, especially in the US at this point of time, is the uncertainty quotient has risen, right? So as you rightly said, it's almost impossible to predict what will happen tomorrow, what will happen next week, what will happen the month after that. Because you can't even price in, or you can't even build your business strategy basis an announcement which came last Friday, because it could change the next Friday, right? So it's pointless. I mean, all of us go back to Excel sheets and say, okay, gainers, losers, this is how businesses will have to rejig. This is what we will have to do to readjust to the, let's say, for example, new tariff rules. But then the tariff rules changes in a week or 2 weeks' time. So you can't really budget for it. So unfortunately, the one casualty which happens whenever uncertainty rises is capital spending. Most people tend to hold back, saying, since we don't know what the next year or two will hold for us, since we don't know what kind of policy regime to work with, let us just postpone capital spending for a while. And that has its own feed-through effect in the economies in terms of slowdown. So and also the risk premiums come off because people want to become a little bit more risk averse. Now that's at the broad level, I think what the global picture should look like over the next year or two. Having said that, our markets look very different at this point of time. There's a full-on risk on at this point. The riskiest part of the market and the highest beta and highest momentum part of the market is actually doing significantly better as compared to the so-called safe and high-quality part of the market, at least in the last 1 month. And as you pointed out on the show a little while ago, quite a few stocks are up 40, 50, 70, 80% in just 4 to 8 weeks' time. I think that has got to do a little bit with where there is increased optimism with respect to earnings growth coming through, if not immediately, at least from a 3 to 5 year horizon. That is point one. And point two is our markets, and I've been saying this for a while, and I think I mentioned this on your channel once or twice. Retail has become the price setter and institutions have become the price takers. And that's a segment retail money wants to play in. And that's what is being driven. So last point on the macro front, this is definitely an opportunity for India. Because another thing which is clear is that everybody is looking at alternate supply chains, China plus one, etc., etc. And this time we have to seize it. I mean, that's the biggest point I want to make. This time we will have to capture the opportunity with both our hands, because we missed it in 2008-9 when a similar opportunity presented itself. So I'm hoping this time we will actually be able to capitalize on the opportunity.
Yeah, well, let's see. There's a lot going on. And we need to see if we can just keep walking our path, whether it's manufacturing, whether it's make in India, or self-reliance in areas like chemicals and defense, so on and so forth. Good to have you on, Dheeraj. I was just, while you were speaking, I was also counting the number of trading days the market has been testing traders' patience.
Right.
And it's 15 to 16 trading sessions where we have been doing nothing. We're in a 500-point band, 24,450 on the downside, 25,100 thereabouts on the upside. Typically these long periods of consolidation, they are followed by a big move, either on the upside or the downside. I know maybe an unfair question, but what do you think? Higher chances of an upside breakout whenever this ends, or a downside one?
I think the range trading with a slight upward bias can continue for many months. And I'm actually sensing a huge similarity in the market right now as compared to what happened between Jan to May 2024. Backdrop is very similar. November, December 23, markets went up about 12 or 13%. Jan to May 24, if you actually plot the Nifty chart, it's literally like this. So point to point, in those 5 months, Nifty was up just 3.5%. But you would see, if you actually look at the internals, you would see 4% up, 3% down, 5% up, 4.5% down. Innumerable number of times, broadly trading the same range. But within that, the kind of stocks which are doing well, those kind of names actually went up 40, 50 to 80% in that 5-month time horizon. And I see something similar happening. So I'm not very hopeful that the market will break out of this range. It could break out a little bit and go another 200-300 points higher, but that's okay. I don't see a huge move on either side at the Nifty level in the next few months.
Okay, all right. Hi, Dheeraj. The big cue that we're looking at for today is going to be the RBI governor. 25 basis points appears it's baked in. And maybe that good GDP number that we got, could be one of the excuses they give that not going with 50 basis points. We'll have to see how that goes. But in a rate cooling off cycle, what is the top theme that you'll play? NBFC as well, they'll have some part of their borrowing mix that comes in from banks, so they'll benefit in a cooling interest rate scenario. Could have the real estate pack as well, or maybe some of these, companies that have larger debt in their books. How would you play this rate cutting cycle?
So, real estate is an obvious one, and real estate demand has been looking pretty strong in the last few quarters, last few months as well. All the data coming out is quite strong. NBFCs do benefit, but remember, most of the NBFCs are trading at valuations from where I don't know if there are large upsides left anymore. So, that's another large conundrum in the market at this point of time. If you pick any sector or stock which is actually doing well, where there's high degree of margin of safety or high degree of predictability of earnings, there is a discomfort on the valuations. And if you go down a couple of layers where you can find some ideas, there is a discomfort on fundamentals. So one of my friends and colleagues, not colleagues, one of my friends, and a very senior fund manager once told me recently in a conversation that I've never seen a market which is so priced to perfection. That is very difficult to find a decent quality asset which is offering you that mispriced opportunity of making some easy returns. And which is what you're seeing reflected in the Nifty, right? It's just not able to break the range because there isn't enough for it going at the mega cap, large cap, high quality stocks level for it to break the range.
Dheeraj, the issue then is, this kind of a market for the average retail investors, when the DIY retail investors, it also starts getting frustrating, right? Because it gets harder and harder to find the stocks that will do the 20-30% in a trading market, in a ranging market rather. What do you think of the current stories that have run, still continue to run in parts? For instance, defense. That whole valuation argument can probably be tossed out of the window. But then again, it's that situation that people find themselves in. What do I buy? Because where valuations are maybe comforting, like FMCG, stocks are not moving. And then the ones that are moving like a Cochin or the whole defense pack, I mean, the numbers perhaps don't make sense at some level. But what's your thought?
See, it's a difficult call from 2 points of view. I mean, it's very difficult to justify fundamentally why this stock should continue to go up from here. But why is it a difficult call to say that don't buy or sell them here is because it can go higher, right? And that's a very weird kind of a conundrum. And I can explain that only by drawing parallels from the history. So, and my favorite example for that is September, October 99. I mean, one of my most revered fund manager, Prashant Jain, HDFC Mutual Fund, September, October 99, he brought his IT holdings down to zero. Now, Wipro was trading at probably 125, 150 times PE multiple at that point of time, or 100 times PE multiple at that point of time, I don't remember. But between September 99 and March 2000, that's just 6 months. 6 months, Wipro went up 4.5 to 5 times. And it's just illogical, but it went up 5 times. For somebody who's playing it, somebody who was smart enough actually to exit close to the top, there was a lot of money to be made. But could you fundamentally explain it? Could you fundamentally explain even a good quality company like Wipro trading at 600 times PE multiple? I don't think so. So these things can happen in the market, and hence it's very difficult call to say the current momentum names can't go up 20, 30, 40, 50% more. But in a number of areas, I would just warn that if you're riding the tiger, be ready to jump off at the first sign of trouble. Otherwise, the pain after that could be really bad.
Okay.
A clear, unforgetful riding the tiger quote, you guys.
Oh, we can, Mr. Ramalinga Raju, who can ever forget? Yeah, reading that press release out. I mean, yeah.
Very briefly, is buying defense stocks here akin to riding the tiger? Quickly?
I think they are expensive. I don't think they're in a bubble yet.
Okay.
Maybe not yet, but could it become at some point of time, looking at the positive momentum? Perhaps.
This is good. Ride the tiger carefully. That's the key takeaway. We got it. Thank you for that, Dheeraj.
Okay, all right, Dheeraj, thanks a lot for that. By the way, at the bottom of your screen, there's another large trade that's taking place, Azad Engineering. Just keep an eye out on that stock. It's down close to around 8-9%. I think 2-3% equity changed hands. We'll try to get you a further insight in terms of who could be the potential names, but the stock clearly has moved to the low point of the day. That said, let's focus on Kaynes Technology, and to help us out with their vision ahead, they've got a big plan in terms of scaling up business. We have with us Mr. Jairam Sampath, the whole-time director of the company. Hi, Mr. Sampath. Good morning. Thanks a lot for joining in. And I've gone through the numbers. Brilliant outlook is what you'll have given. But first, let's address the year and now. The promoter entity earlier this week went ahead and sold a percent in the company. Could you tell us why was that done, particularly in the backdrop that you all have taken an enabling resolution to do a QIP? So does the promoter entity intend to sell more stake in the company?
No, there are two different parts of the, let's say, dimensions to this activity. One, promoter wants to actually create something called a Kaynes Center in Mysore. We've been wanting to do it for the last several decades to add reputation to our company and then give it a slightly higher kind of brand image. And we cannot actually lose money from within the company for that. So promoter does not mind, diluting and then doing this. So he's going to create a Kaynes Center, which will be like a part educational, part scientific exploration center in Mysore. And so that's his intent. He's been thinking about it for the last several years. So we thought we'll start it now because 3-4 years time frame it will happen. The QIP is to fund our...
Just a minute, Mr. Sampath. First, let's get this out of the way. Yeah. So it's a noble thought that he has, to create that center. And he's raised close to around 600 crores. Is that money enough, or will he have to sell more to, for creation of this? Is he done?
No, I think he's done for at least some time now. This particular thing will last. This project will last for about maybe 5 years time frame.
Okay.
And hopefully, will get there what he wanted to do, a large Keynes center. And see, for him, the entire life is the company.
Yes.
Whether he does it personally or whether he does it within the company, it's all the same.
Taken that on board, sir. So for the remainder of this year, can we assume that he doesn't come to sell more stake?
Oh, no, not at all. Not this year. Some more time now. Yeah.
More than a year, he will not be selling stake.
Several years.
Got that. So that's put to rest. Now you had an enabling resolution of a QIP, and the street was hot on this. Could you tell us where does that stand? Will you be raising the money, in the coming month?
Yes.
And quantum will be 1,600 crores?
Yes, 1,600 crores, and we'll be raising the funds shortly. See, if you remember, we had talked about $1 billion sales by FY28, and that seems to be visible now. So then the question that came to us is what happens thereafter? We've been talking about a 50% CAGR. So by FY30, so the first billion came in 40 years, but the second billion will come in 2 years time frame. So we want to make sure that FY30, $2 billion happens with some little bit of, let's say, margin to spare. So that's why we said we'll take some steps here. They're essentially in 3 areas. One is geography expansion. These are all, let's say, inorganic expansions. The second is in the area of getting some design capabilities, ODM, to shore up our margins further. And third is to get deeper into technology, because I think going forward, it's going to be a global arena. So we need to be technologically savvy. So these are the 3 things, small, big beginnings. Maybe about 800 crores into geography expansion, 400 for the other 2, design and deepening the technology footprint.
So the inorganic opportunity is around 800 crores. Is that correct?
Yes.
Okay, all right. And we'll be hearing about the acquisition then in the next couple of quarters, right? If you're going to be raising money this month.
Yes, you will. We had already acquired one company in Canada. And so...
okay, Mr. Jairam, just sorry, apologies to interrupt there. That's the RBI governor walking in. Those are shots which are coming in, from the Reserve Bank of India. The policy going to get underway in just a bit, and we'll start our policy programming in just a bit as well. Jairam, go on. Sorry, please, I interrupted you. Finish that point.
Yeah. So the point is that we had already acquired 2 companies. One small company, $6 to $8 million turnover. That was Digicom. And then later on, recently we acquired a company called August Electronics in Canada. That's about $45 million US or 57 million Canadian dollar. And we are quite enthusiastic that these kinds of acquisitions will definitely add the quantum of, let's say, beachhead for sales, which we badly need if we have to cross $2 billion sales in FY30. And so that's very important for us to make sure that you make the beginning now, so that 5 years time frame, we can grow these businesses to $200, $300 million businesses in the US. As you know, US is the largest market for our kind of electronics.
Yeah.
So in order to partake some portion of that market, I think we got to be there.
I'm glad, Mr. Sampath, I'm glad you touched on that point, because really wanted to understand this. I mean, your overall exposure across your businesses, whether it's semicon, whether it's PCBs, whether it's, all the segments you operate in, total exposure to the US. But before I get to that, since you're talking about another acquisition, last time we had spoken in May, you had given a guidance of about roughly 60% growth for the current year. Did that bake in the acquisition, or was that just 60% organic top-line growth? And it could be more than that if you do this acquisition this year.
Yeah, no. So it's very, the math is simple. So this year, based on India geography business, we will do about 4,350 crores. And another 175 crores comes by consolidating the acquisition that we already done. So we plan to consolidate at least 6 months. Maybe if you're lucky, we can do 8 months too. So 175 is crores is the quantum of business that will consolidate from our Canadian entity. 4350, I think 4350 itself grows at a big number, compared to last year's number. So total is 4525, I think, and hopefully we'll exceed that. And we have also guided for a slightly increased, expanded EBITDA number. It's about 15.6% or so. So I think it's fair to say that next 2-3 years time frame, we are in an expansion in terms of profitability.
Sure. So I take that point. You're saying that from the number you'd given us in May, which was 4525 crores, maybe the top line ends up being even better than that. Got that point. Okay, now very quickly, just a few questions to understand your exposure to the US and whether there is any risk given everything that's going on. Just tell us, sir, what percentage of your revenue is coming from exports? And within that, how dominant is the US as a geography?
Yeah. So this year, FY26, if you see, broadly about 15 to 20% will come from, let's say, exports. And I think most of the incremental businesses will come from US geography. And I think our exposure to US geography is used to be very minimal in the beginning. We used to have one client in the US called Amitech, and then we had some clients in UK and Europe. Now we have other bigger clients. And so it is going to increase, but nothing.
From what to what, sir? From say 1%, 2% of revenue over the next 2-3 years, where do you see that US number moving? Would be 5% of your revenue, 6, 7? Just some idea as you scale up.
No. Consolidated way, I think by FY27, we should do, including semiconductor and PC boards, etc.
Yeah.
Export per se will be touching about 25% plus. Now, out of it, some will be Europe and bulk of it will be US.
Bulk of it will be US. Okay,
Yeah.
so which brings me to the central question then, sir. The market would want to know if there are any inherent risks building in. Because doing business with the US, I mean, things change at the drop of a hat, at least, in the present dispensation.
Yes.
So can you tell us, I mean, how firm are your plans? Will the clients continue to come in? Because for instance, I think some of the, on the semicon side, some of the tie-ups that you have had are with US entities.
US companies, yeah.
Yeah.
So fundamentally, most of the demand centers are not in the US, though the entities that we export to, like aerospace, avionics, etc., they go to the US, but then they come back into places like India, because India is one of the largest buyer of aircrafts. So from that perspective, I guess the risk from the demand perspective is not there. And this is a necessary component of, let's say, supply chain routing. So if we didn't export to US, you cannot really make the US or Europe. You cannot make really our electronics as part of product which comes back in India too. India is not yet fully self-sufficient in terms of, let's say, aircrafts and things like that, right? So from that perspective, I think risk is not there in terms of the demand side risk.
Okay.
Execution always will be, let's say, will be affected by all these pronouncements. But actually speaking, relatively speaking, post this new administration in the US, we are probably having a better time than before, because there's a net differential in terms of tariffs and, let's say, perception. Real tariffs, I don't know when they will implement, but perception-wise, India is seen as a better country.
Okay, all right. Mr. Sampath, final question before we let you go. Ola is one of your clients, right? Could you tell us what kind of revenues do they contribute to you? Point number one. Point number two, if you could tell us, the smart meters, what was the revenue in 25? What will it be in 26? Just these two queries, and then we'll wrap up on this interview.
Absolutely. So last year we did about 500 crores of smart meter. This year we'll do about 1,000 crores.
Okay. And Ola?
Ola will not grow, I guess. I mean, I can't really talk about a company's growth plans, but I think...
No. What is their what part of your revenues come from there?
It's not a huge number. I can't really give you specifics, but it's not a huge number. It's going to probably, if at all anything, come down in terms of our composition for this year, because they are redoing their strategy. So as and when they come back, I think we will then see it at that point in time.
Okay, all right, Mr. Sampath, out of time, not out of questions, but thanks a lot for joining in and give us some clarity on business. Important to note, the promoter entity will not sell more stake in the company, and we look forward to the QIP as well. Appreciate you joining in and speaking to us here on CNBC-TV18. On that note, though, we'll wrap up on Bazaar, but our policy coverage starts on the other side of the short break. We connect with a whole host of experts to address the much-awaited policy, and RBI Governor as well will be addressing the press at around 10 a.m. Stay with us.
Hello and welcome to our special coverage of the Reserve Bank of India's monetary policy, coming to you straight from the precincts of the RBI, Mint Street as we call it. Well, it could be an also-ran 25 basis rate cut policy, or it could be a policy of fireworks. We will know shortly in about 10-15 minutes. Joining me is Ritu Singh, my colleague from the Mumbai studios, and a bunch of guests. Ritu, over to you. Good morning. You did the poll, so tell us what the market's ready with.
Good morning, Lata. You know, the fireworks, if any, aren't likely to come from the rates, but it is the other policy measures that the street will really watch out for. 25 basis points rate cut, that's pretty much factored in. Anything above that, you know, there's a few outliers like Soumya from State Bank of India that are expecting a 50 basis point cut. Now, that is going to come as a big surprise if it does come at all. But of course, what the market will watch out for apart from this cut is the macro factors. Now, the GDP forecast for the current fiscal is at 6.5%. If there is a downward revision there or any risks cited from growth, that will give market cues about how RBI may look at rates going ahead. And importantly, the CPI forecast at 4% for the fiscal, the street actually has a number which is at least 50 basis points lower than that. So if they reduce that and that opens up room for further rate cuts, that's something we'll watch out for. The majority of our respondents are expecting a 10 to 20 basis points downward revision at the very least. Where will the terminal rates really grow? You know, the consensus is about 5.5 to 5.75%, and the rate cutting cycle is largely expected to end by December, although some are even betting on the end of rate cuts by August itself. Not much is expected on liquidity because, you know, RBI has already done a lot, and it's really the mandate of RBI more than the MPC, so we're not likely to hear much other than the fact that RBI will say we will keep adequate liquidity to direct to the real sectors of the economy. On non-policy measures, you know, anything on gold loans, given the government's recent comments, anything on the liquidity framework, including NBFCs, you know, some of it talking about in the external benchmark link rate, those are the things that we really look out for.
Oh, yes. Gold loan companies, of course, will have their ears pricked, their antenna up. Yeah, I mean, what about this foreign bank shareholding thing? Maybe he could electrify the atmosphere with something on that. But that, I guess, will be the press conference. Let me straight away introduce our guests. We have Nilesh Shah of Kotak, Parul Mittal of Standard Chartered, Indra Nilpan, the chief economist from Yes Bank, and Sakshi Gupta, the economist from HDFC Bank. Ladies and gentlemen, it's an even house. Thank you very much for your time. Nilesh, let me start with you. What's the market expecting? What can be the outside surprise?
So whatever Ritu has summarized, that's the perfect summary. It just shows how predictable this monetary policy has become from a market point of view. Everything is under control, growth above estimate, inflation well within control, banking system fairly balanced on liquidity. So RBI will probably go as per the market expectation, 25 basis point rate cut, growth estimate probably keeping same at 6.5%. And inflation, while the actual number or the street number might be lower, they may just go ahead with 4% number to keep some buffer.
Okay. But a 50 bips cut could mean that you will sell off banks. I mean, there could be a trading sell on banks.
Undoubtedly, 50 basis point is going to have a material impact on banks' NIM margin. So there will be some sell-off if there is a 50 basis point rate cut in banking sector.
Okay, Parul Mittal, of course, would be the master at knowing what the bond market is thinking. Parul, what's the market prepared for? What will be the outside surprise? How may yields move if there is ultra dovishness or not so much?
Hi, Lata. So this time, market is pricing in exactly 25 basis points of rate cut for this MPC. And this we can see how the OIS curve is priced in. If we look at the bond curve, it's the shorter end of the curve is trading below the SDF rate itself. So 1 year T-bill is trading at 5.6%. So that tells us that apart from the rate cut expectations, there is a positive overhang from the liquidity surplus in the interbank market. So market has nothing to complain about over the last couple of months. Liquidity and the inflation coming down has really boosted markets' comfort on policy rate cuts. This is a very special policy where the fear is, what if RBI gives a bigger and bolder rate cut? And if that happens, I think market is not currently prepared for it. We can see material moves if that small probability of a larger rate cut materializes. And our governor has surprised the markets on the stronger action from RBI in the past. If we look at their policy on dollar rupee, on liquidity itself, the surplus which has been given is bigger than market participants anticipated. So very interesting policy, very finely priced in, exactly 25 basis points of rate cut expected, and a fear of a larger rate cut from RBI.
Yeah, there can be an argument made that the RBI wants the repo rate at 5.75, although the repo is today at 6. The call rate is at 5.75. So why not give a 50 bips cut and do reverse repo to keep the call rate at the repo rate? In that case, an argument for a 50 bips can be made, and continuous reverse repo to keep the call rate aligned to the repo rate. That argument can definitely be made. We will have to see what he would do about that. Indranil Pan, besides the 25 basis, what else would you watch?
I think for me, the very critical thing is, first of all, the base case is 25 basis points. I think the commentary for the future is very important for me. Now, the reason I say so is that there is no sort of grave fear on the growth. Yes, if I accept the potential growth rate for the economy at about say 6.5 to 7%, we are more or less there. And there is no grave fear that growth is sinking, which necessarily means that I don't expect a shock treatment from the Reserve Bank of India, even though inflation has surprised to the lower side. The critical thing I would be looking for also is how much they reduce their inflation expectations number. Now, the broad, as you street expectation is about, say, a 10 to 20 basis points, which doesn't make a material difference to me. But for instance, the RBI sort of is bringing down the inflation forecast by about 50 basis points. That clearly is a signal for the forward or the forward guidance that the depth of the monetary policy easing can be significantly more. Now, the other reason why I don't expect a 50 is that we are reading newsprints that early rains may have damaged crops in the southern India. And there has been an uptick in prices of vegetables, especially tomato, which will probably be filtering into the market over the next 2 to 3 weeks. So that's also the reason, and given the various uncertainties from the global markets where inflation seems to have stalled and global rates being on the higher side, I would not sort of want the RBI to provide a 50 basis point shock.
All right, 50 basis points, a shock if it comes. Sakshi, are you at all pricing in any surprise apart from the 25 cut that is expected? And on the macro front, what sort of revisions, if any, are you expecting?
Right. Good morning. So, I broadly agree with what's been already said. I think 25 basis point rate cut is also my expectations. I don't think the RBI would want to rock the boat and deliver a 50 basis point cut. On inflation and growth, I think it is too early for them to kind of change or tinker with the forecast that we saw in April. And, given that food prices can be extremely notorious, in the months of, July and August, I think that they'll kind of keep that cushion. And for now, I would expect them to keep their inflation as well as growth forecast unchanged. I think it is too early for them to kind of revise down their inflation forecast. I think, one of the things that I would kind of watch out for is the tone of the monetary policy and their assessment of how domestic growth is doing, not just in terms of, any sort of impact from global headwinds, but how is the domestic recovery panning out, over the last couple of months. So their comfort around that, because I think that will give us some perspective on, what comes next. So are we looking at a further 25 basis point cut or a deeper rate cut cycle? So in terms of forward guidance, I think their commentary on growth will be very important.
Yep, I completely agree. We would watch out for 6.5 is where RBI stands. 6.3 to 6.8 is what the chief economic advisor has been saying for some time now. RBI is at the midpoint. Anything lower can mean that there is more dovishness. But Nilesh, what about outside the policy? What would you like to hear on gold loans? What would you like to hear on this, foreign bank shareholding that suddenly become very newsy? Even if he doesn't say anything in that statement, you can be rest assured that we are all going to ask him. So if he says, for instance, yes, we are reviewing, we don't mind a larger foreign bank shareholding, who gains? Will the chota private sector banks, old private sector banks become active, become interesting for you?
So undoubtedly, when a strong promoter steps into a banking system, investors will be positively looking towards it. Second, as this smaller guy gets bigger promoter, better promoter, their ability to compete with larger players also increases. And hence the entire banking system will have to be reevaluated. On the gold loan, whenever stock market goes up, we see beneficial impact in real estate sector. Far bigger wealth creation has happened on the gold. But unlike stock where there's no emotional attachment to sell, on gold for whatever reason, there's emotional attachment. I think if we can liberalize gold loan and ensure that this wealth effect translates through credit into other parts of economy, it will be better. Obviously, the gold loan, if done properly, is one of the most secured way of lending, and hence it can be pushed to create growth in economy. One more thing, Lata, we will be looking forward in this policy if there is a hint. RBI is running a fairly large short forward dollar position. What will be the game plan over there? How will it get unwind? The reserves are comfortable. So how will that get unwind will be something we will be looking forward to in this policy.
Parul, very quickly, could there be any possibility of widening the corridor, reverting back to pre-pandemic levels of that 50 basis point gap between repo and STF? Or you think this corridor is still serving its purpose?
So yes, there is a bit of discussion around whether RBI would want faster transmission and therefore widen the corridor so that the excess liquidity leads the banks to either lend at their SDF window 50 basis points lower than the repo rate, and that can then propel their propensity to extend credit and bring down the lending rates in the system. I think there are two choices in front of RBI. One, to either give a larger repo rate cut or to move the SDF window lower by another 25 basis points. I think given how RBI has been very focused on keeping the volatility in the overnight markets lower, I would personally give a higher probability to a deeper rate cut rather than widening of the corridor. I think RBI would continue to focus on keeping a control on the overnight rates closer and in the narrower corridor that has been their policy focus over the last few years.
Okay, so that's something that RBI is unlikely to do, at least in this policy. Quickly, Indranil Pan, non-policy measures, you think the liquidity framework, which has been under discussion with some of the bankers of late, is that something that RBI could discuss in this policy?
I would guess no, because as Parul also rightly mentioned, that they are not going to widen the corridor. So the liquidity measures are under discussion, and I think unless the sort of first document is placed for public discussion, I'm not sure whether the RBI governor will let out anything on the liquidity framework immediately in this policy.
Okay. Sakshi, what is your sense? Any other non-policy measures that you would watch out for?
Right. I mean, Ritu, at this stage, on the liquidity side, I also agree. I don't think that, we will hear too much around the, new liquidity framework. Also, in terms of, liquidity measures, the RBI has been already, very active on that front. System liquidity is now close to, a surplus of 2.9 lakh crores. I think they will talk about...
And namaskar. The 55th meeting of the Monetary Policy Committee was held in the backdrop of an early and promising start of the monsoon season. This is of vital significance for the Indian economy. In contrast, the global backdrop remains fragile and highly fluid. The uncertainty around the global economic outlook has somewhat ebbed since the MPC met in April, in the wake of temporary tariff relief and the optimism around trade negotiations. However, it is still high to weaken sentiments and lower global growth prospects. Accordingly, global growth as well as trade projections have been revised downwards by multilateral agencies. Moreover, the last mile of disinflation is turning out to be a little more protracted. As growth-inflation trade-offs is becoming more challenging, monetary authorities are charting out a more cautious and carefully calibrated policy trajectory. Looking beyond the near term, growing economic and financial fragmentation is reshaping the global economy. Besides complex interconnections with the financial system, elevated debt levels, and growing influence of frontier technologies like AI are raising financial stability concerns. Amidst heightened volatility in capital flows and exchange rates, coupled with constrained policy space, central banks of emerging market economies have a tougher task to stabilize their economies against global spillovers. In this global milieu, the Indian economy presents a picture of strength, stability, and opportunity. First, strength comes from the strong balance sheets of the 5 major sectors: corporates, banks, households, government, and the external sector. Second, there is stability on all 3 fronts: price, financial, and political, providing policy and economic certainty in this dynamically evolving global economic order. Third, the Indian economy offers immense opportunities to investors, both domestic and foreign, through 3 Ds: demography. We have a high proportion of the working age population which is growing. It is becoming more literate, it's becoming more educated, more skilled, urbanized. Then there is the third D, the second D, the digitalization. We have very advanced and sophisticated public digital infrastructure. And domestic demand is the third D, which we are talking about over here, which is very important given the trends of deglobalization. This 5x3x3 matrix of fundamentals provides the necessary core strength to cushion the Indian economy against global spillovers and propel it to grow at a faster pace. We are already growing at a very fast pace. 6.5% is the highest, not only last year amongst major economies, but even in the last decade. Of course, we aspire to grow at a higher rate, and we are making all efforts in our vision of a Viksit Bharat by 2047. I now come to the Monetary Policy Committee decisions. The Monetary Policy Committee met on the 4th, 5th, and 6th of June, that is today, to deliberate and decide on the policy repo rate. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%. I repeat, the reduction recommended by the MPC is for 50 basis points to 5.5%. This is with immediate effect. Consequently, the standing deposit facility rate, which is the STF rate, shall stand adjusted to 5.25%. And the marginal standing facility MSF rate and the bank rate shall stand adjusted to 5.75%. I shall now briefly set out the rationale for these decisions. Inflation has softened significantly over the last 6 months from above the tolerance band in October 2024 to well below the target. Latest numbers are 3.2%, with signs of a broad-based moderation. The near-term and the medium-term outlook now gives us confidence of not only a durable alignment of headline inflation with the target of 4%. You are aware we had earlier projected for this year an average inflation of 4%, as excluded in the last meeting, but also the belief that during the year it is now likely to undershoot the target at the margin. While food inflation outlook remains soft, core inflation is also expected to remain benign, with easing of international commodity prices in line with the anticipated global growth slowdown. The inflation outlook, therefore, for the year is now being revised downwards from our earlier forecast of 4% to 3.7%. Growth, on the other hand, remains lower than our aspirations amidst challenging global environment and heightened uncertainty. Thus, the MPC felt that it is imperative to continue to stimulate domestic private consumption and investment through the policy levers to step up the growth momentum. This changed growth inflation dynamics calls for not only continuing with the policy easing, but also the MPC felt front-loading the rate cuts to support growth. Accordingly, the MPC voted to reduce the repo rate by 50 basis points to 5.5%, as already mentioned. After having reduced the policy repo rate by 100 basis points in quick succession since February 2025, the Monetary Policy Committee also felt that under the present circumstances, monetary policy is now left with very limited space to support growth. Hence, the MPC also decided to change the stance from accommodative to neutral. From here onwards, the MPC will be carefully assessing the incoming data and the evolving outlook to chart out the future course of monetary policy in order to strike the right growth-inflation balance. The fast-changing global economic situation too necessitates continuous monitoring and assessment of the evolving macroeconomic outlook. I will now come to the assessment of growth and inflation. First, growth. The provisional estimates released by the National Statistical Office placed India's real growth in 24-25 last year at 6.5%. During 25-26 so far, domestic economic activity has exhibited resilience. Agriculture sector remains strong with a very good harvest in both the Kharif as well as Rabi cropping seasons. The supply of major food crops is comfortable. The reservoir levels remain healthy. The highest procurement of wheat in the last 4 years provides a comforting stock position. Industrial activity is gaining gradually, even though the pace of recovery is a little uneven. Services sector is expected to maintain momentum. PMI services stood strong, as you are aware, at 58.8 in May 2025, indicating a very robust expansion in activity. On the demand side, private consumption, which is the mainstay of aggregate demand, about 56% of the total GDP, remains healthy with a gradual rise in discretionary spending. Rural demand remains steady while urban demand is improving. Investment activity is reviving as reflected by high-frequency indicators that we track. Merchandise exports recorded a strong growth in April 2025. Of course, this could be because of some front loading, but this is after a lackluster performance in the recent past. Non-oil, non-gold imports posted a double-digit growth, reflecting buoyant domestic demand conditions. Services exports continue on a very strong growth trajectory. Both the last month's figures have been quite robust. Going forward, the outlook for agriculture sector and rural demand is expected to receive further impetus by the expected above normal southwest monsoon rainfall. On the other hand, sustained buoyancy in services activity should nurture revival in urban consumption. The healthy balance sheets of banks and corporates, governments continue to the government's continued thrust on capex, elevated capacity utilization, improving business optimism, and easing of financial conditions should help further revive investment activity. Trade policy uncertainty, however, continues to weigh on merchandise exports prospects. The conclusion of the free trade agreement with the United Kingdom and the fast progress that is being made in our negotiations with other countries, on the other hand, should provide a fillip to trade. Spillovers emanating from protracted geopolitical tensions and global trade and weather-related uncertainties pose downside risks to growth. Taking all these factors into consideration, real GDP growth rate for this year 25-26 is projected at 6.5%. We continue with our earlier forecast with Q1 at 6.5, Q2 at 6.7, Q3 at 6.6, and Q4 at 6.3%. The risks are evenly balanced. I will now move to inflation. CPI headline inflation continued its declining trajectory in both March and April. The headline inflation moderated to a nearly 6-year low, in fact 69 months to be precise, to 3.2% in April 2025. This was led mainly by food inflation, which recorded the 6th consecutive monthly decline. Fuel group, which had been earlier witnessing deflationary conditions, there was a reversal of the deflationary conditions, and it has recorded positive inflation prints in the last 2 months of March and April. This is partly because of the hike in LPG prices. Core inflation remained largely steady and contained during March and April, and this is despite the increase in gold prices, which exerted an upward pressure. The outlook for inflation provides towards benign prices across major constituents. The record wheat production and higher production of key pulses in the Rabi crop season should ensure adequate supply of key food items. Going forward, the likely above normal monsoon, along with its early onset, augurs well for Kharif crop prospects. Reflecting this, inflation expectations are showing a moderating trend, and this is more so for the rural households. Most projections point towards continued moderation in prices of key commodities. This includes crude oil, which is of critical significance to us. Notwithstanding these favorable prognoses, we need to remain watchful of weather-related uncertainties and the still evolving tariff-related concerns with their attendant impact on global commodity prices. Taking all these factors into consideration and assuming a normal monsoon, CPI inflation for the financial year 25-26 is now projected at 3.7%. As I mentioned earlier, this is a downward revision from our earlier forecast of 4%. We are projecting inflation for Q1 at 2.9%, Q2 at 3.4%, Q3 at 3.9%, and Q4 at 4.4%. The risks are evenly balanced. I'll now come to the external sector. With a moderation in trade deficit in Q4 24-25, alongside strong services exports and remittance receipts, the current account deficit for last year 24-25 is expected to remain low. We are yet to get the final figures. Furthermore, despite rising geopolitical uncertainties and trade tensions, India's merchandise trade remained robust in April 2025. As imports grew faster than exports, trade deficit, however, widened during the month, which is the month of April. Going forward, net services and remittance receipts are likely to remain in surplus, counterbalancing the rise in trade deficit. The current account deficit for this year, 25-26, is therefore expected to remain well within the sustainable levels. On the financing side, in 24-25, foreign portfolio investment to India dropped sharply to $1.7 billion US, as foreign portfolio investors booked profits in equities. Net foreign direct investment, FDI, too moderated. I would like to take a moment over here because there has been large and widespread commentary on this moderation of net FDI. Now, we look at net FDI primarily because of our concern regarding foreign exchange reserves, where the net becomes important. It's not only the net the inflows, but also the outflows, which actually lead to either an accretion or a depletion in the foreign exchange reserves. However, when it comes to investment, then it is the gross FDI which is actually important, and gross FDI last year actually increased quite sharply. 14% is a very robust growth that we had, $81 billion US. And so India continues, therefore, to be an attractive investment destination, despite there being a moderation, as we are seeing in net inflows, which is primarily because of rise in repatriation, which is again which is a very good sign of a maturing market, where foreign investors can enter and exit smoothly, and at the same time higher gross FDI, which is again a sign of our large industrial and other companies going out and investing. So on the whole, gross FDI is high, which indicates that India continues to be a good and attractive investment destination. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to the previous year, as on May 30, 2025, India's foreign exchange reserves stood at $691.5 billion US. These are sufficient to fund more than 11 months of goods imports and about 96% of external debt outstanding. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve. We remain confident of meeting our external financing requirements. Now I come to liquidity and financial market conditions. You are all aware that the RBI over the last few months, in fact since January, we have injected a lot of durable liquidity through various means, through OMOs, through the CRR rate cut, through the buy-sell swaps, OMOs, etc. A total of 9.5 lakh crore rupees of durable liquidity has been injected into the banking system since January. As a result thereof, after remaining in deficit since mid-December, liquidity conditions have transitioned to a surplus at the end of March. And this is also evident from the tepid response to the daily VRR auctions, which got a bid coverage ratio of only 0.26 in the recent past, and also from the high STF balances. They are averaging about 2 lakh crore rupees in the last 2 months, that is April and May. Similarly, reflecting the improvement in liquidity conditions, the weighted average call rate, which is the operating target for the monetary policy, this traded at the lower end of the LAF corridor since the last policy. The comfortable liquidity surplus in the banking system has further reinforced transmission of policy repo rate cuts to the short-term rates. However, we are yet to see a perceptible transmission, although there are incipient signs of transmission to the credit market segment, but it is still not perceptible. Although we are aware, and we need to keep in mind that it does happen with some lag. The Reserve Bank remains committed, as we mentioned earlier, to provide sufficient liquidity to the banking system. To further provide durable liquidity, it has now been decided to reduce the cash reserve ratio, the CRR, by 100 basis points. I repeat, we have decided to reduce the cash reserve ratio by 100 basis points from 4% to 3% of net demand and time liabilities. This will be done in a staggered manner during the course of the year in 4 equal tranches of 25 basis points each, coming into effect from the fortnights beginning September 6, October 4, November 1, and November 29 of this year, which is 2025. The cut in CRR would release primary liquidity of about 2.5 lakh crore rupees to the banking system by the end of November 2025. Besides providing durable liquidity, I would like to emphasize over here and highlight that it will also reduce the cost of funding of the banks, thereby helping and accelerating the monetary policy transmission to the credit market. I would like to reiterate that we will continue to monitor the evolving liquidity and financial market conditions and proactively take further measures as may be necessary for liquidity and for monetary policy transmission. I will now come to financial stability. The system-level financial parameters of the scheduled commercial banks continue to be robust. The asset quality parameters, liquidity buffers, and profitability parameters have shown further improvement. The credit deposit ratio for the banking system at the end of December 2024 was at 81.84%. This is broadly similar to what it was a year ago. Similarly, the system-level parameters of NBFCs are sound with comfortable capital position and improved GNPA ratios. The stress witnessed earlier in retail segments like unsecured personal loans and credit card receivables portfolio has abated, while the stress in microfinance segment is still persisting. Banks and NBFCs active in these segments, however, are already recalibrating their business models, strengthening their credit underwriting practices, and stepping up their collection and recovery efforts to avoid any excessive buildup of risks on this front in future. I now come to the end of my statement. On both inflation and growth fronts, the Indian economy is progressing well, and it is broadly on expected lines. And this is despite, the huge uncertainty that the global uncertainty that we have. Strong macroeconomic fundamentals and benign inflation outlook provide space to monetary policy to support growth while remaining consistent with the goal of price stability. As global environment remains uncertain, it has become even more important to focus on domestic growth amidst sustained price stability. Accordingly, today's monetary policy actions should be seen as a step towards propelling growth to a higher aspirational trajectory. Here I would also like to highlight that there is no tussle between price stability and growth in the medium and long term. Price stability preserves purchasing power. It imparts certainty to households as well as to businesses in their savings and investment decisions, and it ensures congenial interest rate and financial conditions. all of which foster consumption, investment, and overall activity and therefore growth. Moreover, this is crucial for equitable growth and shared prosperity because its absence is disproportionately burdensome on the poor. I must also add over here that while price stability is a necessary condition, it is of course not sufficient to ensure growth. A supportive policy environment is vital. And this is even more important during periods of high uncertainties such as the current times that we are witnessing. At the Reserve Bank, therefore, while price stability remains the focus of monetary policy, we are not oblivious to putting in place complementary monetary as well as credit policies and regulations that support growth and prosperity. Thank you, Namaskar, and Jai Hind.
Oh my God, this is a very startling policy. It means both a CRR cut and a repo cut of 50 basis points. So this is definitely an extremely pro-growth policy. And the last sentence that while we understand that inflation is our prime goal, we will not be oblivious to the importance to support growth during uncertain times. Clearly that statement is also extremely dovish. We perhaps are not seeing too much of a movement in yields simply because the rate cutting cycle seems to have ended for now. The policy has gone on to neutral, so we can't take further rate cuts for granted. That may be a bit of a negative, but I would think that it is positive. Banks, it's positive immediate fall in lending rates, and therefore, I mean, I would expect that the market is going to celebrate this in a decent fashion. Let me immediately get to our guests. We've got Sakshi, Upasana, and others with us, Rajiv Anand as well. Rajiv, first to you. Actually, what is the net impact if you've got a CRR cut, which liberates, you know, a 2.5 lakh crore on which you guys can earn anything from 6 to 7% by lending it? What is the impact on margins this year?
I think clearly, you know, like you rightly said, this is all about, you know, front-loading liquidity and rates to be able to get to a new trajectory of growth. And I think clearly in that context, the CRR cut is a huge positive. Our estimates and very early estimates